Hello and welcome to Benefits Weekly. All right, our topic this week, as we sit here in November of 2025, renewals are coming in. So the question is a simple one. What's up with group health plan renewals? Why are they getting so dang high? Eric?
I guess you expect me to have an answer, huh? Yeah, I mean, a few weeks ago we talked about the individual market and the enhanced premium tax credits may be going away, and at the time we touched on the fact that individual renewals are through the roof this year, and kind of when we turned the camera off, we kept talking and said that the same thing is happening in the group market. And I know that where we are here in Texas, small group renewals in particular, most clients are seeing somewhere in the 22 to 25% range, which is just insane to pile that on top of already high renewals, or already high rates.
Wow. Yeah. And I think, it's interesting as we look at small group, and just a reminder for our audience, when we talk about small group, we're generally talking about what is a kind of definitional term in the health insurance world. So usually that's going to be companies with 50 or fewer folks that are getting insurance, or I should say are eligible for insurance. And in some states, so that is going to be 100, depending on if the state drew its small group cutoff line at 100, as some of them did. I think California and a few others did years ago. And these small group risk pools, as we call them, are similar to the individual market risk pools now in that they're community rated, and they're guaranteed issues. So, Eric, can you kind of explain a little bit more on this whole idea of community rating, what that might mean?
Sure. When the Affordable Care Act was signed into law, one of the ideas was get everybody into the same pool and make the plans guaranteed issue. And so basically, small employers qualify on a guaranteed issue basis. The insurance companies are not able to charge more based on medical conditions. They can't even ask those questions. So basically, what goes into developing the rates is the ages of the employees and dependents and the location of the group, and that's about it. But of course, when we're looking at the renewal increases, that's not all explained by age. Everybody's a year older, and certainly that has an impact. But the bigger factor that is impacting the rates is the fact that health care costs are going up a lot. So medical inflation is part of it, but it's really a little more than that. And it's the fact that some of the carriers that have the big blocks of fully insured business are losing some of their quote unquote better risks, the ones that have fewer claims. They're finding other solutions, and that leaves that population a little bit older and sicker, and the insurance company has to adjust for it. And I think that's something that maybe lawmakers, when they originally created the Affordable Care Act, were not counting on. They didn't expect there to be these sort of alternate markets for the healthier groups. And so it's sort of the guaranteed issue thing is sort of backfiring at this point.
Yeah, and just to translate, when we talk about the alternate markets for these groups, we're talking about level funded solutions. We're talking about getting on a PEO's group benefits plan, joining a MIWA if you've got those in your market. There's captives, these other solutions out there that aren't part of that fully insured community risk pool. And to your point, Eric, we are seeing these small group community risk pools shrink. And I showed you some data the other day, and I remember you kind of reacting like, "Oh,
It,
wow."
it's kind of crazy. Yeah. And it does prove the point that some employers are finding other options, other solutions other than that fully insured small group market. And so nationwide, the number of lives covered by small group fully insured plans has dropped significantly since the ACA went into effect.
Yeah, and just to put some numbers on it,
Oh,
here's
wow.
some data directly from KFF. So, a lot of the major provisions of the ACA went into effect in 2014. And so KFF has this nice database they show. They talk about where they cite everything from on the website, and we'll link to the website in this week's article, but there were 16.8 million people covered across the country in the small group risk pool as of 2013. Fast forward 10 years later, the latest data they've made available at KFF, it's shrunk to 10.3 for a 39% decrease. Now, if you look at Texas, which is where Eric and I are based, and
Even worse,
actually,
isn't it?
yeah, it's even worse. And I'll tell you, it aligns with kind of some anecdotes. If you think about the fact that Texas was an early adopter of level funded solutions and other alternative solutions. And so in Texas, when we look at the data, it's actually been a 48% market decrease in that decade.
That's crazy. And you know what what I think is equally crazy is that, we sit here in the insurance industry and shake our heads at these numbers and, say what's happening to the small group market. But in reality, as insurance advisors, we are sort of contributing to the problem. And the reason for that is, we have clients. We have a fiduciary responsibility to those clients to find them the best solution that we can. And oftentimes that solution is something other than a fully insured plan. And so we take our healthier clients, we recommend level funded plans or PEOs or captives or what have you. They benefit from that. They're able to find a better solution and keep their premiums under control. But what's left is a fully insured risk pool that is, as I said a while ago, it's older and sicker. And because of that, the insurance companies do have to adjust their rates. So while there is no medical underwriting on a per group level in the small group market, there certainly is medical underwriting based on the entire block of business. And it is justified. I mean, as high as the premiums are, some of the dominant small group carriers, the ones that have most of the fully insured business, and in most states there is one dominant player. If they if they didn't increase their rates, they'd be losing money.
Yeah. And I think, when you're on the receiving end of a rate shock, I mean, and spoiler alert, even my family and I who are in the individual market got a rate shock this year. It feels very willy-nilly. Why are they increasing my rates so much? I didn't even use any healthcare this year, or, we're all doing well. Why am I getting this giant increase? It's important for us to remember as advisors that if we're representing the carrier as an agent, or obviously representing our client too, but it's the carriers who appoint us at the end of the day to be agents. It's important to remember that these carriers have to get these rate increases or these premiums for the following year filed with and approved by the relevant Department of Insurance in that state. And as part of that, they're providing these actuarial memos. And, if you'll indulge me for a moment, I can actually show you a great website that you can go to. So this is called ratereview.healthcare.gov. And you can go in here and choose a state. So I'm going to choose Texas because that's where we are, Eric. And I don't want to look at individual right now. I want to look at small group, but individuals there too. And I can submit a search for the 2026 year filings. And on here, we can see which companies are offering fully insured small group products in the state of Texas and what kind of rate change they both requested and what was approved going into the next year. And if you want to take it one step further, and maybe I'll just pick on Blue Cross here for a second. Although I could click on any of these, here we can see the different products, and there's some complexity to how these things get filed, like the number of actual plan designs to a product and all that. I'm not sure how it always works, but if you actually do a few clicks in, you can get all the way into some actual kind of formal documents. So one is called the consumer justification narrative, where they kind of explain how many people they insured, how much premium they collected, how much claims they paid, and the justification for the rate increase. I'm not sure how consumer friendly it is, even though it has consumer justification in the name. But what's also really interesting is you can go in and actually see the actuarial memos that were used to justify it. Now, a lot of these will have a lot of black ink on them because things are redacted, I think, for competitive reasons. But here's a really good example. Let's see if I can zoom in just a touch, where it explains, of that on average 15.7% rate increase that they filed going to 2026, what were the different things driving it? And
Wow.
to Eric's point, if we add up these two, pricing trend, which I think is basically medical costs, utilization and unit cost, and population morbidity, that accounts for, what is that, 14.6 of the 15.7%
Wow.
rate increase. So it's not just that we have a health insurance, premium issue in this country. We have a healthcare cost issue in this country, and then a commensurate risk pooling challenge that we need to address.
I think one other thing to point out here, because I know that, some folks watching this are probably saying, well, wait a minute, what do you mean 15.8% renewal increase? Mine was 25. The truth is that those are averages, and there is a difference from, one network plan to another, PPO to HMO. There's also a difference within the networks. It might be that the platinum plans get a higher rate increase than the bronze, as an example, or copay plans get a higher increase than HSA plans. So there's going to be some variation. Also, when they file those rate increases, they're doing it based on the same age. But when you go from one year to the next, everybody is a year older. So if there's no demographic changes in the group, no turnover, the average age has gone up 1 year. And if it's a young group that's going from average age of 26 to 27, that's not a big percentage increase. But if you look at that age curve at older ages or older average ages, if you're going from an average age of 57 to 58 in a group, that's a few percentage points on top of that big rate increase that you see, that we just looked at. And so you add it all together, and it's more than 20% for a whole lot of groups out there.
Yeah. Well, I wish we had a quick fix here that we could tell everyone, here's how to save your client money. And Lord knows there are a lot of solutions out there claiming they'll help your clients save money. As always, it's on us to beware of simple fixes and simple solutions. There's usually always a benefit and a trade-off that needs to be considered when we're advising clients. But as we think about this fundamental issue with just the price of health insurance and the underlying cost of healthcare increasing so much, ultimately it's probably going to come down to some policy fixes or adjustments, I want to say, at the federal and the state level. And so, here we are. We've just come out the other side of the government shutdown. There's still some open questions on the tax credits in the individual market. But I will say, I feel like I'm seeing headlines that maybe, those in power on both sides of the aisle are starting to realize maybe we need to have some conversations again as a country at the highest levels of office to see what else can we be doing to address some of these challenges. So Godspeed to them.
Yeah, I think, we've all seen the way the government operates. They oftentimes, as we saw with the government shutdown, wait until it's an emergency to deal with stuff. And a lot of people would say we've gotten to that SOS type level, in the health insurance arena. And so yeah, fingers crossed that we'll actually see some positive bipartisan discussions and maybe some solutions emerge.
Yeah. And look, Eric and I are just nerds. We don't have all the solutions, but maybe that's something that we in future episodes can unpack some ideas that we've heard thrown around and maybe provide a few of our own comments and criticisms on what's maybe a good idea or not. That could be fun
Exactly.
future content here. Awesome. Well, I think we'll wrap it there, Eric, if it works for you.
Yeah, I
As
think
always,
we do have much more in the article, so please do take a look at it. And if you have your own ideas, please share them with us.
as always. And if you enjoyed this week's content, the best thing you can do is share it with a friend. Thank you so much. Have a good week.
Thanks, everyone.